Bandhan Mutual Fund presents MF Corner.
Hello and welcome to the special edition of MF Corner YouTube edition. Thank you so much for tuning in as always. Today what we are going to be discussing is mutual funds and exchange traded funds. What is the difference between both of these? What are the returns here? What should you choose as an investor? Which is the best option for you? We're going to be discussing all of that. And to discuss that, we do have Mr. Saibal Biswas, who's the founder and mentor at Saibal Biswas and Associates, joining in with us to talk to us about that and explain you all of this as well. Thank you so much, Mr. Biswas, for joining in with us on the show. Let's start by just the basics in terms of the difference between mutual funds, exchange traded funds, the structure, the management, the trading, the returns. If you could just start by that for us.
Yeah, thank you for inviting me. I think the ETFs, which is acronym for exchange traded funds, are actually trying to replicate the benchmark. So it finds a benchmark like a Nifty or a Nifty 50 and then tries to replicate that. But a mutual fund is basically a vehicle where you put your money, you buy your units from the asset management company and sell it back to the asset management company. Whereas the ETF, you have to buy it from the market and you can sell it back into the market. And the initial amount that was allocated to the ETF remains the same. And after that, it is only traded in the market. Expense ratios for both are different. The ETFs are far more cheaper, whereas the mutual funds are a little more expensive than the ETFs. But you can trade live for an ETF, whereas in a mutual fund, it is the day and NAV that you buy and sell with. The management of each of them are different. ETFs are left to the market, whereas the mutual fund companies are actually managed by the asset management company. And structurally, if you look at it, you might feel that mutual funds are largely non-benchmarked or active funds, whereas largely ETFs are passive.
Right, sir. So we are talking about mutual funds which are actively managed, while ETFs obviously are more passive, right, is what I'm understanding now from what you're explaining. So what does this mean for investors in terms of return and risks over here?
So when you invest in a benchmark, then you're replicating the benchmark. So you don't generate an alpha largely. You are replicating, your returns are largely predictable. You know that you put your money in benchmark and you will get the returns that a benchmark generates. Whereas a mutual fund largely manages active funds and depends on the expertise of the fund manager, the teams, analytics teams, etc. So the risk in the case of a mutual fund is higher than an ETF, and the expenses, however, in an ETF is lower than a mutual fund. So you have to evaluate both of them in terms of what your risk appetite is and choose the funds based on the expenses that they charge and also the kind of performance that they generate. In terms of risk, it's important to say that mutual fund will always be taking a higher risk to generate a higher return and beat the benchmark, whereas ETFs will continue to remain predictable and lower risk because they're just replicating the benchmark.
Mr. Biswas, historically, how have ETFs performed versus mutual funds, right? ETF, if they're benchmarking, the index, then how is the performance that you see coming in? And is it always a better option than to go for mutual funds? Because then the fund manager has the option to switch between different kinds of funds or different kind of, sectors as well. How does that work?
At a mature market, like let's say a US, you will see most of the cases the ETFs are actually beating many of the active funds. But in markets like India, maybe the large cap space, it is important to have ETFs because they beat the active funds sometimes. But in the small and mid cap space where there are market inefficiencies, I think the fund manager has a role to play. He can beat the market if he is efficient and he does his research. But if you ask me, then in a large cap space, it's mostly ETFs. In the mid and small cap space in India, still there is a space for actively managed funds to participate and outperform.
So, now in this current scenario, which is a better option if I'm a long-term investor? What should I go for right now then?
Yeah, for a long-term investor, if you have chosen the correct actively managed funds for the long term, you can actually get much greater return than the benchmark. However, if you're a short-term trader, maybe you can use ETFs because the expense ratios are low, they're market-driven, you can get the pricing from the market, so you can actually trade them. But if you're a really long-term investor, then you put your bucks on the table on a fund manager who is managing for the long term and actively managing, and he knows his job, then he can get you higher returns than ETFs in India.
Right. And what about short-term investors? Is ETF a better option than right now if you're just a short-term trader, 3 to 6 months?
Yeah, expense ratios are much lower, so you can trade them. They're available on the stock exchange, so you can buy them and sell them at any point of time. You can sell out and buy them cheaper, etc., etc. Whereas in mutual funds, you must look at long-term, because many people use mutual fund as an SIP vehicle, which you can't get it in ETF. So if you're a really long-term investor, then you start doing your SIPs, do your financial planning, target your goals, and start doing SIPs in long-term, actively managed funds.
Right. Sir, just to follow up on this, like you're saying, mutual funds gives you that SIP option as well. So even if you have a small amount, you can invest. And today we have those options that have come in of 250 rupees as small as that amount as well, right? So if I have a small budget, what makes sense to invest? Like, what is the option that I should go for? Then should I just start going for mutual funds versus an ETF? Or can, even with a small budget, someone can invest still in ETFs because it's less expense ratio and, you can exchange and the funding can be done on a day-to-day basis as well?
So if you ask me, that I think it should be a mixed bag. It should not be that you should have either mutual funds or ETFs. There are two different vehicles trying to achieve your financial goals, but in a different route. So if you ask me, then I think you should, in a large cap space, you should allocate to ETFs because the expense ratios are lower and they're mostly benchmark hugging. Whereas if you're looking at mid and small cap space, then your SIPs or your lump sum investments should go towards mutual funds, which try to beat this benchmark, try to use their expertise, try to use their analytics, their research, and try to create an alpha, which the ETFs are not intending to create. So I think you can have a mixed bag. It is not that you can have or, but you can have both together in your portfolio.
Okay, have both together in your portfolio. That was my next question in terms of a diverse portfolio, right? Asset allocation is the key when you are investing in mutual funds so that you get the best benefit. How much would you say has to go? Maybe someone has 10,000 rupees, suppose. What should go as a percent to ETFs? What should go as a percent to mutual funds?
Okay, I will put this like this, that if you should have a core portfolio and you should have a satellite portfolio. Everybody has a core portfolio and then you should have a satellite. Your core portfolio, which should be the large cap space, must go into ETFs. And the satellite portfolio, which you should have, which gets you the greater alpha, should go towards mutual fund companies. Now, asking on a number crunching, what should be the core portfolio and what will be your satellite portfolio quantum? I think it depends on your risk appetite. It also depends on your age. It depends on what kind of allocation you're looking for. But I believe it could be even a 50-50 ratio on an average. But I think the main focus should be that your large cap, consistent index portfolio should be in ETF, and the ones that you want to generate that additional alpha should go towards the portfolios held in mutual funds, which use the market inefficiency to generate greater returns.
Okay. And just want to understand, can one actually use ETFs? Like you were saying, ETFs is more on those large cap side, right? So I want to understand, can ETFs actually be used to create a similar asset allocation strategy, somewhat on the lines maybe of a mutual fund? Is that something that is possible to do it individually?
Absolutely possible. So if you look at the various benchmarks that the ETFs are using today, and benchmarks are also evolving. There are various indexes which are coming up. In the US, there are multiple indices to work on. So in India also, there will be more indices which will come up. So there are large cap indices, there are mid cap indices, there are other elements like gold and silver ETFs which are available. So if you want to do a pure asset allocation only in the ETF platform, it's absolutely possible. So you break down your overall portfolio across various asset classes and do asset allocation. across various types of asset allocation products that are available on the ETF platform. Absolutely possible.
Okay, that's interesting to know. And liquidity, I just want to understand that, can investors face liquidity issue when trading in certain kinds of ETFs? Is that a problem, and is that a risk that an investor should be aware of when they're investing in ETFs?
Excellent question. I think this is very least talked about thing. Mutual funds, you go back and sell it to the asset management company and they buy back from you, give you the money in 2-3 days. Whereas in ETF, you have to be in the market, you have to sell it back to the market. So you have to have buyers. So if you have certain very acute indices, which are not really, doesn't have buyers, then you can be stifled with some cash flow issues or some liquidity issues. I think you have to be careful. You have to look at the cash flows that are available in the market for those indices, and then choose. So only choosing an expense ratio or just choosing indices in terms of returns is not enough. You must check the volumes, the trading volumes, to check what are the trading volumes available before you choose the ETF that you choose.
Okay, Mr. Saibal, thank you so much, for joining with us on the show, explaining our viewers mutual funds, ETFs, the difference, the pros and cons of both these, and which investors can actually look at investing in mutual funds and ETFs according to the time, the horizon that they're planning to hold on to. So thank you so much for that, and thank you so much for tuning in.
Thank you.
Bandhan Mutual Fund presents MF Corner.